All right, Dave, this is the topic that I think everybody's been waiting for, to talk taxes.
I don't know if you're right.
You were one of the most enthusiastic people this morning on the phone, wanting to know about how I could not pay as much tax.
Everybody hates tax, but we need to preface this. We're not talking about paying tax. We're talking about an episode on how to not pay tax.
We've got a good friend of mine here on the podcast. We have Kyle Woiwood. He is with UHY, currently a partner there. UHY and Associates. What is it? UHY?
UHY Advisors.
Advisors. I should have known that, but that's what you get when you bring one of your friends into the studio.
Yep.
I don't want to discredit him for not being professional or an expert because he is one of my friends. So he has his expertise coming in partnerships, corporations, LLCs. He's got his bachelor in accounting from the University of Northern Iowa. He likes playing golf, having a couple of glasses of bourbon. And like I said, we're here today to talk taxes.
So why is it important that we, 3 years deep, 4 years deep now, every year at the end of the year, we talk taxes? Because this is when everybody thinks about it. Why is it important before the end of the year to talk taxes?
Yeah, Kyle, I'll let you take that question. Why is it important to care?
Well, like you guys mentioned, I'm always the fun guy at parties when talking taxes, and so this is just something that everyone loves talking about.
Everybody just wants free advice.
Yeah, well, obviously there's something to that too. Before the end of the year, there's things we can do, is the short answer. If you wait until the end of the year, or even the beginning of the next year, there are certain things that we just can't do. And so usually around the late October, November, and certainly December timeframe, CPAs are swamped with year-end planning. And so that gives us some opportunity to look at, okay, what has the year been like so far? What's been good? What's been bad? What do you anticipate coming for the rest of the year? And what do you still want to do? What's the next few months? What's the next couple of years look like, so we can actually plan for that? And so getting in front of your CPA, telling your story, that allows us the options and still have some time to go out, and if you need to buy more equipment, if you need to do certain things, or if you don't need to do those things, that just lets us know where we're at.
Yeah, I feel like I've got a majority of my client base at the bank that says they're going to have a meeting with their accountant. And that's usually a December meeting, and it does exactly what you just said. They want to know how much of their inputs they need to prepay. Or if they need to come to me and start asking questions about loan amounts for a Section 179 expense. So we're going to get into those details during this conversation, but as you have this meeting in December with your clients, how do you usually approach that? What is something our listeners could expect out of one of those meetings?
Well, certain clients are more involved with their CPAs throughout the year. And so if you're one of those, there may not be a whole lot of catch-up necessary because we've been talking throughout the year. Others, maybe this is the first time we've talked since we did your tax return last, March, April. And so really that first point is to have enough of your financial information put together, summarized in a good format so that we actually have something usable to talk about. And then it really is, what are your goals? What's the next year looking like? And do you have a plan? Do you need advice? Do you know what has changed in the tax law situation that maybe you need to investigate further? And so that's really where a lot of those conversations trend to is where are you at? I fill in with the here's what's changed, here's what's different, and we kind of go from there.
I got two things across my mind, guys. First off, are we talking to just farmers, or are we talking to anybody and everybody? Because I think the answer to your question, Tanner, of what to bring in would be different. And I think as our conversation goes to you, the listener, if you're a farmer, you have a multitude of different things that you could do, maybe more than the average business owner, because you can pre-buy seed, you can pre-buy inputs, you can 179 deduct a tractor, et cetera, et cetera, et cetera. Whereas the average business owner, it might look different. Like, hey, can we start a 509, 529? It's for our kids for college or something like that. So I think depending on the listener type, you guys might take this a different way. The question.
That's a good point, because even if you're an employee of a farm,
yeah,
listen, there's not a lot of tax planning you can do because that's going to come in the form of a W-2 or a 1099, and you don't have very many write-off-able expenses.
So then when I think what Kyle was saying, he said, well, bring, kind of generically worded it, some kind of financial statement that you know how much you made. For our farmer listeners, they might not know yet. That's why you said December. They're all waiting, harvest is in, okay, we got this many bushel, we're thinking this much, we pre-sold this much, we didn't pre-sell that much, so there's a lot of strategy that's gonna go into that. For a guy like me, you said throughout the year, we're talking with our tax accountant, quarterly, if not monthly, to make sure that we're paying quarterly. And so it's all in QuickBooks. So then my mind went right to that. How many people come to you that use a digital software of some sort that you can even see the back end before they even get there?
More and more, the software is becoming much more user-friendly. So QuickBooks Online is one that you can just have a subscription-based, you can get on your website and you can see it, you can give your accountant access, very simple. QuickBooks Desktop is the old legacy, little harder to work with, but a little more robust. I would say I see a lot of people doing that, but what I would also say is I see a lot of people using that to varying degrees of accuracy. Some people have it, they're paying for it, but they don't know what the heck's in it, they don't know what it's doing. I have other people that are much better, and I have some people that outsource it to an accounting firm to help them out throughout the year. So there's a lot of variability. Just because you have QuickBooks does not mean that, ta-da, here's my financials.
So should we take a class? And I'm asking that because I took a class. My accountants actually put us through a class on QuickBooks to make sure that we were doing it accurately. Was her suggestion. If farmers were doing that, they're like, yeah, I got no time for that. But what's your recommendation there? Should they, or should they outsource it?
As much as I would want to say, oh yeah, everyone should go learn how to do QuickBooks, it's not real. I think being knowledgeable enough to do, there's some bare minimum things that you can do. Bank reconciliation is probably one of the easiest things to do. You link your bank account to QuickBooks, it pulls in things automatically, and then you go classify, okay, what did I spend on this? What did I spend on that? You're the best person to know as a business owner what you spent your money on. If you have an accountant do it, we're likely going to have questions. Well, you bought something on Amazon, you bought something at Walmart. What was that? Because you could have 10,000 different things.
Tanner, here's my tech tip for the day. So on ours, our accountant taught us that every time I go to Casey's and it's more than a certain amount, automatically reconcile it and put it in this box over here called fuel. So if I spend more than $100 at Casey's, assumably it's already fuel, and it does it for you.
Yep, and there's a lot of things that you can make your life a lot easier by doing things like that.
Yeah.
But yeah, you got to have the time and you got to be somewhat diligent in order to keep that going, because it's really easy to fall behind.
I get quite a few interim financials from business owners and farmers that when they send me their P&L, it's got an expense category that says, ask my accountant.
One of my least favorite accounts out there.
Ask my accountant. I think we have one of those, yeah?
That's pretty good.
So they bring all their stuff.
Yep.
Okay, we're up to that point. They have, hopefully, I made 400,000 this year. I made 100 grand. I made 50 grand, whatever the number is. And now we have a conversation. Do they come to you with ideas like, I already want to do this, and ask your permission? Or should we just wait for the accountant to tell us what to do?
Honestly, I like it when people come in with here's what I'm thinking, because that way then I can take that and I can apply it to the law and we can come up with something that works. If a client isn't expecting a CPA to be the answer to everything, I'd say that's a little more dangerous, because we don't know your business, we don't know what your goals are, and so us telling you something may not actually be the best way to go if we don't fully understand what you're looking for.
All right, listeners, I have a whole nother question. I got a banker and an accountant sitting next to me here. Now, I have ideas of what I think I should do with this money. Who do I talk to first? Do I talk to you, Tanner?
No, you start with the accountant. You start with the accountant because you need to know if you can do it and if it's going to help you first. It's no sense in coming to me with an idea to go do something and get an approval from me, and then you go to Kyle and find out that it's not going to benefit you. I also, just for the sake of relationships, I don't want you to go and spend a lot of time with your banker chasing down an approval for something that can't work. It's better off to come and say, yep, we do need to do something section 179 for an example. That means I got to go buy a piece of equipment. And then you come to me and ask if we can financially cash flow or if I can give you some funds available to make that purchase. So I would say your CPA first is the place where you start.
I would echo that. Not that I don't think any of my banking friends could give some advice, but it does help just to know what the rules are, what are your options, and then the bankers are able to tell you, okay, how do we do this from a financing standpoint?
Right, so now we're 10 minutes into the conversation, and we've talked about how we can establish an efficient meeting with our CPA. But really what I think people turned into this episode for is to get the updates.
Sure.
What was different from the last year that we did this episode in December to where we're at now? So start with some highlights, pick a couple of your favorites out, and let us know what's new.
Sure. So, I mean, when I think back to 2017, I know that's going a little far back to now, we've had a lot of change year over year over year. And in the middle of that, we've had pandemic, and we've had some kind of short-term pandemic law changes as well. From 2021 to 2022, less severe changes in terms of at least at the federal level, what has transpired. There are certain things that are indexed for inflation that have gone up, such as the Section 179 deduction. That's going from $1,050,000 up to $1,080,000. So you get an incremental increase in the amount that you can 179. The mileage deduction has kind of gone back and forth. It was in the mid-50s, it jumped up into the low 60s for kind of a COVID deal. It's actually going to jump back down to 58.5 cents. And for Iowa listeners out there, there are quite a few things that have changed in 2022. 2021, I guess I should start with bonus depreciation, Iowa coupled with. That was a huge deal.
That's right.
For a
Define
lot.
coupling.
So Iowa states in general have the ability to say, okay, here's the federal law. What of that law do we want to follow exactly in that state? And so that's called coupling. For years, Iowa would take the federal law and say, well, now we're going to do these certain things different. That was 179, that was bonus, that was the qualified business income deduction, that 20% flow-through deduction. Well, now, for the most part, they have coupled on many, many different things. There's still a few that they haven't with, but bonus depreciation for years was one of those Fed Iowa differences that made it really complicated to kind of plan for. Beginning in 2023, actually, tax rates are going to go down.
Really?
Yep, so the Iowa individual rates are scheduled to go down through 2025 to a maximum of 3.9% flat, which is a big deal for a lot of people. The corporate rates actually are scheduled to go down, but it's not a guarantee that they're going to go down. There's some budgeting things, but basically they're working their way down to a flat 5.5% tax. So big things coming up in that realm. Speaking of bonus, one thing that I think will affect a lot of people that utilize bonus right now, that is actually scheduled to start phasing down. Right now, bonus depreciation is at 100%. Beginning in 2023, that goes down to 80. The next year, 60. The next year, 40, all the way down to 0 under the current law. So, well, okay, this is a 2022 tax abatement. Why does that matter? Well, if you have capital expenditures that you're looking to utilize and you want to make sure you can write it off, Section 179 is still there, but if that doesn't work and you utilize bonus and you wait to 2023, ta-da, now you only get 80% of that as a write-off in the initial year.
In the first year.
In the first year.
The other 20% can still be written off on the regular schedule.
Exactly.
You just can't accelerate it.
But if that's a 15-year asset improvement, now you're taking that remaining 20% and deducting it over 15 years versus under current law right now, 100% of that is in year
Right.
one.
So I need an example.
Sure.
179, I'm familiar with knowing what that is. What's the difference between 179 and bonus?
So different.
How would a farmer use bonus?
So I would say farmers are more likely than not using Section 179. So that is an asset by asset election, and there are specific rules as to when 179 is eligible to be used. Without getting too nitty gritty in the weeds, the contrast of bonus is that basically if you buy something, a new asset to you, and it has a useful life of 20 years or under, it's going to be eligible for bonus. So the rules under 179 are more restrictive, and that if you don't qualify under 179, bonus would then be available to you to still give you that 100% deduction. So in all likelihood, I see farmers use a lot of Section 179. But let's say you're putting in a whole lot of capital improvements in a particular year, because there is a maximum per year. If you buy, actually I have it written down here, for 2022, it's $2.7 million. if you placed more than $2.7 million of capital improvements in service in 2022, then that 179 deduction starts phasing down. You don't get to deduct that whole $1,080,000. And so that may not be your circumstance, that may not be a lot of people's circumstance, but if it's yours, that could be something that you're banking on this big deduction and now it's not available to you.
Which would be another reason why you go talk to your CPA first, instead of coming to talk to your banker.
Well, and I could think of like putting a whole new grain leg or something like that. You go,
Yep, a whole new facility.
whole new facility, that could get you there.
Absolutely. So we talked a lot of Iowa-specific things there. Do you see the trend of other states also going to that flat tax scenario?
Without getting political, I think it would depend on the state. I think there's differing agendas state to state, and I think Iowa's taken the position that they want to see tax rates being reduced, and that was evidenced by the law passed by Governor Reynolds last year, and a lot of those tax cuts are coming through to fruition. One thing I did not note in another 2022 planning thing is that historically on your Iowa tax return, you've been able to deduct the federal taxes that you've paid in the particular year.
Right.
Beginning in 2023, that is no longer how the calculation works. The federal taxes you pay are no longer a deduction on Iowa. So for years, CPAs have said, hey, we think you're going to owe for federal, let's make the payment in December. We'll get that as a deduction on your Iowa return and save you a little bit of a timing difference, if you will. Well, that's going away, so 2022 becomes extremely important to make that payment in December because this is our last shot at it.
Right, no kidding. That is a good piece to add. I know a lot of our listeners have been through some natural disasters over the last couple of years. We've got listeners that are going through drought. We've got listeners that have been through 2 derechos. We've had flooding. What types of disaster-like programs are we seeing available to us for tax planning, and what do we need to pay attention to?
Sure. So the easiest one is that if you are in a federally declared disaster zone and you have a related disaster loss associated with that, that's going to be deductible on your subsequent tax file.
What if you filed for crop insurance on it? Is that like double dipping?
So it can be, and so it can depend on the program, and it can depend on, let's say, facts and circumstances. And so you do want to make sure that you check to make sure what kind of payment have you received and what are you deducting against. So I don't want to be too specific saying yes or no, but it depends is the short answer. I have seen, for example, if we have any Florida listeners, the hurricane that hit Florida, the IRS actually granted an extension to file your tax return until I believe it was February. And so,
Really?
Yeah. Now that does not exclude penalty and interest, but it just gives you more time to actually to file the return.
Because the normal extension deadline is the end of October?
Yeah, so it's September 15th for flow-through entities and October 15th for corporate entities.
Yeah. So that's pretty generous, but of course that's about the time the hurricane hit.
That's exactly right, yeah. So no, hopefully everybody stayed safe with that, but yeah, a little more time to file your 2021 return.
Got it. Well, Dave, you work all the time in 1031 exchanges.
Mm-hmm.
And I think when we had this conversation last year, we were afraid they were going to go away.
We were.
But we got to keep them. Is that going to stay? Nothing's changed?
Nothing has changed currently, and so that's the rules we got to live with for now. Will they change? I mean, who knows?
How long are we going to hold the estate tax at 11.7 million? Does that not wash out? I think it's what do they do that every so often, and it will come to another vote.
So back in 2017, when the Tax Cuts and Jobs Act was passed, there were certain things that were made permanent, and there were certain things that were made for 10 years, largely for, let's say legislative purposes, in order to get the laws to work and through both the House and Senate. There are certain things that are subject to sunset after 10 years, which would be 2026. And then at that time, those laws that were not made permanent revert back to what they were pre-2017.
Which is significant on that estate tax, because it was down 3 million?
Basically half.
It was down in half, so hopefully whoever's in office at that time will keep that 11.7 million for estate tax. But 1031s, yeah, they sure fought it big time, and a lot of people sold assets because they were worried that they weren't going to be able to capitalize on 1031, but 1031 and 1033, both for land, are still viable. every day.
Yep, still viable and still utilized. The biggest thing that changed in 2017 was you can no longer defer your personal property associated with an exchange. And so it's just your real property. So think of real equaling real estate, your big ticket items, your land, your building, things like that. So very much still utilized, very much still a tax benefit, but definitely something you want to make sure you plan for with your CPA before you go ahead and do it.
And one thing, I'll tell people, most people don't know this, there's short-term capital gain and there's long-term capital gain. So if you sell that asset, so a lot of people that are buying and selling farms with me as this market has changed so fast, and 37% up, heck, I just bought it 9 months ago, let's sell it, let's make $4,000 an acre. And they are, but they're doing it in that short capture time, then I believe it's ordinary income rate, isn't it? It defaults to your ordinary income rate.
Yep.
And then a lot of people also forget about the net investment tax, which some people call Obamacare or Affordable Care Act, is
3.8%.
3.8%.
Yep.
So on top of, everybody says, oh, it's 15%. Well, yeah, federally it's 15%. And then there's our 3.8 net investment if we make more than, is it 500,000?
Yeah, so yeah, if you make more than 500,000, or, I mean, you do have to be a passive investor or a non-material participant in it before that qualifies, so your
And
investment earnings.
The other thing for everybody that's a listener to think about, if you're trying to 1031 with your family, it gets difficult. Very difficult. So if you're trying to buy Brother Bob's or Uncle Joe's or whatever, you better be talking to somebody that knows what they're talking about or you're going to get in trouble.
That's probably really good advice. It's again, putting that advisory team, making sure you know the right people to go talk to make sure you're making the right choices in your decision making. But that's what I want to go to next is Dave and I talked this morning. Dave wants to know ways that he can reduce the tax payable, the amount due. What are some of your favorite ways, your best advice? I understand this is blanket casting here, but what are some good techniques that if our listeners walk into their CPA, they could say, hey, I heard this on a podcast, could I try this?
So, I mean, the one that everyone thinks of is you go buy a piece of equipment, right? You go buy a combine, you go buy whatever you need from that room, and you take 179 or bonus on it, right?
Yep.
That's very simple to do. I would argue just monitor your cash flow on that. Cash flow is king. As a banker, I know you preach that till you're blue in the face as well. There are...
And you don't get the whole write-off. I mean, you go buy a $100,000 tractor, you don't get $100,000 off of your income that's earned income. You get what, like 30%?
Well, not off your tax. So you'll get $100,000 off your income, but that then is your taxable income. From that, you get a tax assessed on that.
Yeah,
so your net effect
if
is...
you've got $100,000 net income, according to where everything sits during your tax meeting, you could go buy a $100,000 piece of equipment to take your net income down to zero.
Yep. Something that has been, I'm sure most people have seen or maybe even been approached about is this employee retention tax credit. It's all over the news, it's all over the radio waves. Guaranteed up to $26,000 per employee for this amount of time, and everyone gets it, and this and that. What I will tell you is, first of all, the credit is real. There is a credit called the Employee Retention Tax Credit. It can be a very effective tool to get some money back for if you employed people throughout the pandemic. There are a lot of rules, and there are a couple different tests. One is you show a gross reduction in your gross receipts for a period of time. 2020 has different rules than 2021. Very numerical, pretty straightforward.
Very hard for those in agriculture to do, more than likely.
Yeah, it can be, depending
want
facts and
that
circumstances.
Right. Not only have we had inflated commodity prices, we've had historically decent yields, and we got a lot of government payments.
Mm-hmm. So if you don't meet that, there is a second test, and that is for a government-ordered disruption of business, whether that was partial or complete disruption of your business. That is where there is, let's say, some significant gray area. And before you agree to have any company, whether it's who you've worked with historically or somebody new that you got a mailer from, go and sign anything to your business, just make sure you understand what you're getting yourself into. And more importantly, in 3 to 6 years, when the IRS comes knocking saying, hey, prove this amount of credit that you're taking, make sure that that company will be defending you upon audit, because the IRS has flat out said people are being too aggressive with this. They're not understanding the rules. They're taking credit for false for false claims on this, and they will be pursuing it. So that's just my plug for everybody. Just know who you're working with, know how you're getting charged. Also, that's the other big thing is some companies take percentage of the credit they get you, so their incentive is to get as high as possible. But that means you're going to pay them an enormous amount with a large amount of risk as well. So anyway, I'll get off my soapbox on that.
No, but I'm glad you shared that because I've seen ads on TikTok, I've seen ads on Facebook about that, and I'm sure our listeners are seeing the same thing, and they're sitting there thinking, well, yeah, I did have Bob and Jolene and all my trusted farm workers throughout the entire pandemic, and yeah, I couldn't even go into the FSA office, so I had a hardship, I had to do everything by snail mail or leave it in the mailbox, I'm sure there's ways they can justify it to themselves, but just to know that there is some risk associated with that.
It's not a guarantee is what I would say. You may be entitled to that full amount, and I hope that you are, but just make sure that you do trust and to what you can verify what is then being claimed on your business name.
And those are a tax credit, so like the earned or the child tax credit. Basically, if you had to pay in, let's say you had to pay in $50,000, that comes off of that, correct?
So basically, it's a refund of taxes that you've already paid, your business has already paid. And so you actually go back and amend your payroll tax returns to get back some of the tax that you've already paid in. And so in a weird sense, it is a credit, but it's not necessarily a flow through to the individual credit. It's a return of taxes you've already paid.
Gotcha.
Right.
So I've been hearing a big one lately that is the Biden let's spend billions of dollars bill that just went through the anti-inflation whatever.
The Inflation Reduction Act.
That's what it's called. the spend billions of dollars bill is what I call it. That there's all kinds of eco-friendly stuff, even to the point of like solar. So I've been getting ads for solar like non-stop. That it won't cost you anything. Here's what it is. Realistically, isn't it like 30% or something? If you spent $50,000 on your solar, that you get 30% of that back.
Yeah, again, facts and circumstances depending, but yes, for the most part, that's true. There are nuances to that program. That it all depends on how much solar you're generating, how much you're spending. That law is incredibly long and has a lot of different energy efficient credit options. And that could be even if you install energy efficiency appliances or things within your building itself. And so it's not even just solar, it's wind, it's alternative energy sources. A lot of potential there. If you're going to do it, yeah, you want to make sure that you understand those rules. But if you don't have any intent of doing solar or that doesn't fit your business plan, that's really not going to mean a whole lot to you. But yeah, it did extend the tax breaks associated with doing work in that space.
I looked into it, Tanner. Iowa used to do a credit and they don't anymore. But the one thing it did include battery banks. Like everybody sees this Tesla wall thing, or I haven't seen Tesla wall, where you store it because some of the cooperatives, mine, nameless, they're not nearly as good as the one that's locally, and so they won't do net metering. And if you don't net meter, then the only way to make extra is to store it.
Yeah.
Well, I think that new bill includes the storage, but those things are crazy expensive. But we talked and did a podcast with Clover Dance on this, and farmers, this is fantastic. That if you could show that you've increased your energy efficiency, might be a new grain dryer. Like, let's spend some big money, and you might be able to get some of that credited.
That's just, again, that is the perfect time. Before you go out and spend the money, talk with your accountant, see what those rules are. Do they apply to you? Do you meet the conditions, the requirements? And if so, yeah, that's just going to get you some money back, and then you feel good about making that large of a purchase.
Right.
So you got one, because I got one that I'm thinking, and that's fuel. So farmers work fuel, diesel. It's expensive as heck right now, and I see that you put on here that standard rates have changed a little bit. Is it better, before we talk about rates, I've done it where we track the miles and you write in your little logbook, here's, I put 80,000 miles on this year. Is it better generically to do that, or just say this vehicle is owned by the farm and all the maintenance, all the fuel, all the everything is on this vehicle, and then we don't have to track miles?
I think I've said it about 10 times in this podcast so far, so my apologies. Facts and circumstances. I mean, because I'll have salespeople that drive all across the country, and then they drive a little Prius or something like that. Well, they're putting a lot of miles, not a whole lot of cost, so mileage makes more sense for them in that case. If you drive a big old truck and that thing's chugging diesel and you have to repair it every other month or whatever the case may be, then maybe actual makes more sense. And you have depreciation available to you at that point, so you can accelerate some deductions that way. But it really does come back to what's your goal.
If you're gonna try and write off the wife's car, make sure it at least has a hitch on it. Or that camper that you bought, make sure that you have that set up at the edge of the field for field lunches.
That's a very good point, and yes, if you're telling your CPA that vehicle is 100% business use, that is your right to do so, but make sure that you're comfortable with to defend it. That's exactly right. Because if you, in theory, drive that truck home and to and from work, well, that's called commuting, and that's not deductible. So in theory, that vehicle sits at your office every single day. You then drive it for work. You park it back at the office, and you drive a different vehicle home. So it can be a little nitpicky if you're trying to follow the letter of the law, which you should. But just make sure that whatever you're claiming is defendable.
Okay, so now I know there's a couple of tools that we can do using family members. And that kind of sounds bad. We don't want to use our family members, but we can do things within the family that are beneficial. And that's both through either gifting or paying up to a certain deductible level for wages. Is that correct? Let's expand.
Yeah, so you can employ your children. And that's what's frequently we see a lot of people do. And it's okay, what's the most I can pay them? What's this and that? I would say the better question initially is what are they doing? What services are they providing to your business? Because in order for a business expense to be deductible, it's got to be ordinary and necessary. So if they are legitimately doing work for your business and you're paying them a fair wage that you're willing to defend on that, the approach that I see a lot of people use is to pay them at or less the standard deduction for your federal tax purposes. In this year, I can't remember off the top of my head, it's $12,000 to $13,000. Because then when you think about their federal tax situation, they're going to have income of $12,000, they're going to have a deduction of, let's say, $13,000, so they have no taxable income from a federal perspective, so they don't pay tax. If that business is actually owned by a parent or a combination of parents, let's say an LLC, husband and wife combo, and they employ their children, you actually don't have to withhold Social Security and Medicare tax. So essentially, you're able to get them $12,000 of cash with no tax withholding requirement. One thing to keep in mind is that check the state you're living in, because Iowa's standard exemption is not $12,000. So you may have an Iowa withholding requirement that you want to make sure you're meeting so that your kids don't owe tax to them, or just be ready to file a tax return for them to pay that Iowa tax. It's a sneaky tax consequence.
If you start paying your kids, does that count towards their 40 quarters for Social Security?
If you do not pay into Social Security, so basically the example that I used where you're getting out of that because it's
because you didn't meet the standard. Yep.
Yeah, so you didn't pay anything in, so in theory, I don't think that would actually start that clock.
I was just thinking as we build, it's self-employment, we build 40 quarters for our Social Security if you go that route. Okay, so can we gift them like college funds?
So, yeah, that was the other piece that you had mentioned. So gifting, yes, that is absolutely a possibility. So for 2022, it's $16,000 per parent per beneficiary. So
per parent.
Yes.
Per beneficiary.
Yep. So the gift tax rules looks at individual person. How much are you gifting, separate of any spouse? So you could gift $16,000 to your child. Your spouse could gift $16,000 to that child without the need for filing any gift tax return. If you gift $16,001 to that child, you then have to file a gift tax return for that year, just simply disclosing all of your gifts. So once you meet that threshold, you have to disclose all of your gifts for that year. In all likelihood, you're not going to owe any tax. It's a very straightforward filing, unless you're gifting more than that annual lifetime exclusion of 12, 13 million.
How do they look at polygamy? I was just thinking, like, I got 7 wives. We could give this kid $100,000. No, I'm just kidding.
Well, your math isn't very good.
I know.
16 times 7.
That's what I count on you for.
Well, I'm gonna have to go back to the office and look into that a little more. I have not come across that yet.
But yeah, so now we're gonna be back on track. That gifting side, is that a deductible expense for the farm or the business?
No.
So it doesn't lower the tax responsibility. It just allows you to transfer wealth without them being taxed.
That is correct. Yep, that's exactly right.
You can't go into your CPA listener and say, I'm gonna go write off 16 grand, 32,000, or in Dave's case, 100 grand, because
Yeah,
his math's great.
Yeah. But you can pay the kids when you pay them. It's a wage, so it is lowering your taxable income.
Yeah, it is shifting it to them, and again, depending on the amount, if you keep it below that federal standard, they're not, in theory, gonna pay federal income tax.
So paying might count, but gifting doesn't.
Right.
I would just say, you know, I mentioned this before, make sure they're doing appropriate work to justify the wage that's paid. Because if questioned by the IRS, they would say, no, they're not actually doing anything, so.
Is there a red flag for the IRS on age? Like, my kid's 8, but he's good with a computer and does data entry on farmland statistics for me. Are they gonna say 8-year-old is not doing that, but your 12-year-old might?
In terms of red flag, I don't know if I could tell you if that's actually a red flag or not. You know, I do think there are certain situations where people try to be really aggressive with paying a kid, and that can expose it to you, because I know the IRS has a lot of metrics and a lot of things that they track to discover things like that, kind of those outliers, if you will. But I think if all you're doing is paying your kid for reasonable work that is able to be done, they are actually doing it, then yeah, you should be able to pay them a wage as such, as an employee of that business.
That's good to know, because we're gonna probably start inserting my daughters into commercials on the podcast.
Cool.
So we can pay them to do commercials.
So along with vehicles, if we were to buy property, let's pretend we made a lot of money this year. It's like, wow, we're gonna have to pay the government, geez, $200,000, but there's another 50 acres up the road. Probably can't buy that for 200,000, but you get the drift.
Yeah.
But can we go buy more property that just the business owns, and is that, you know, that we just prove that, hey, the business is diversifying and we need more commercial property here and buildings and storage, and also we need this corn ground, and also, or how is that looked at?
So I mean, the short answer is yeah, you can. What I would tell you is if you're trying to get a deduction, buying farm ground is not going to help, because land's not depreciable. So you're going to spend a bunch of cash to buy the land, or finance it however you're going to do it, but you're not going to be able to get a deduction except for things like your tiling, your fencing, your existing agricultural structures. Buildings, yep. So I mean, that just really depends on what your goal is. If you have cash and you're going to be able to make your tax payment, but you want to go use it for something else, absolutely go out and buy farm ground. But it just may not get you a deduction that you may want.
Gotcha. So Kyle, there's selling farmland I get with old guys all the time. I say old guys, geriatric population, Tanner. The guys that decide to sell, which normally by the time they decide to sell, they're there. Is there some rules for something if you're retired, or expand?
Yeah, so that actually was something that passed, this past year. There's a couple different things that I think will drastically help, let's say, retired farmers. The first is an exemption for recognizing certain incomes related to leased land, to rented land. So first of all, you have to be 55 or older or disabled. And another condition is that you can no longer be materially participating in the farming activity associated with that land. So basically, you can't be out there doing anything. It really is meant to be, now you're passive, now you're truly retired, which I know for some farmers is a dirty word, not going to happen. But, that may be a tax planning thing. Maybe you do need to kick your feet up, and all of a sudden we can get rid of some tax. You need to have a written agreement in place. You need to have a written lease agreement for that land. So that's cash rent, that's crop sharing, that's however you're going to monetize that. And then the next piece, I guess, you have to have owned the land or materially participated for at least 10 years. So it can't be something that you bought last year and all of a sudden now you want to retire, you hit 55, and now you can claim this income exclusion. You have to have owned it for 10 years. And then maybe the last thing is, this is going to be a little unique. If you own it in a partnership, for example, so an LLC that there's multiple members, so it's you and a family member, you and someone else, that doesn't qualify. You need to own it outright, personally, and at least under current understanding, if you're a single member LLC and you own that land in an LLC that you own 100% of, we think that will still qualify. I don't know if that's been challenged yet, because enacted in 2023. But then that's going to allow you to exclude that rental income from that activity from your gross income. So if that's your situation, if that's your retirement fund, basically you just generated tax-free Iowa income on the rental of farm ground.
Oh,
And that's because of the qualifications of who it's rented to.
Mm-hmm. Well, so in that.
And that's just Iowa tax, that's not federal.
Correct, yep. So now there's another piece called the capital gain exclusion for retired farmers. So if you are going to sell a chunk of land, and you sell it to a lineal descendant, so a child, I think even a cousin qualifies. Again, you have to be 55 or older or disabled, and you've materially participated for that 10 years, you will be able to then exclude that capital gain from the sale from your Iowa income. And so this is kind of in line with another big thing that Iowa changed. Retirement income beginning in 2023 is now going to be excluded. So whenever you retire, you start drawing from your retirement funds, your IRAs, your 401ks, whatever that may be. Those are no longer taxable by Iowa. So this just kind of fits in nicely with, okay, now I'm a farmer. I don't have a 401k, I don't have an IRA, but I have farm ground. If you truly retire, like your competitors that have worked those type of jobs, now you're in the same boat. That income is no longer taxable for us.
I didn't think they had to sell it to a descendant. I thought if they materially participated, meaning they worked the ground, then they could avoid capital gains tax.
I do believe that descendant is a requirement.
And so now for a couple of my older guys that are getting towards retiring that maybe do crop share.
Mm-hmm.
What is materially participating? If I'm making decisions on share crop to put in, although I didn't run the planter and I didn't run the combine, am I still materially participating?
What I would tell you, because there's a laundry list of examples the IRS gives, still with some gray area, talk with your CPAs is the short answer. There's a lot of ways that you could be construed to materially participate. It's going to be a facts and circumstances analysis. It's going to be what are you doing versus what are you not doing, and are you comfortable enough that what you're doing just does not meet any of those examples that the IRS has given for what a material participant looks like. So that's a very general answer, but there's a lot to that. There's a lot of gray area there. So definitely something you can
Here's what we got, Tanner. If you go to this guy and he says no, go to that guy, I'd probably say yeah. And then go to this guy.
When you go to the second guy, you have to tell them why you showed up. So they know not to say.
Then they know.
It's the fun part about tax. We live in the gray area, and depending on how aggressive or not aggressive you want to be, we can tell you when it's black or white. A lot of gray.
Oh, this has been really valuable again. I think we could continue to have a conversation and keep plugging away, even though some people might think taxes are boring. Our listeners know that paying attention to the amount of tax that you pay is super important. So I'm going to try and summarize.
Okay.
And then we're going to give you 2 questions to close out with.
Okay.
The first one is the one we ask all of our guests. And one is, what is the best advice you've ever been given? The second one is what are some things that your top tier clients doing that you think would benefit everybody's business or farm?
Okay.
So you be thinking about those. I'm going to try and do some summary here, Dave. You get to challenge after Kyle's answers.
Okay.
So we were here, Kyle Woiwood from UHY, talking about tax planning. So pay attention to if you are deducting your mileage. The standard mileage rate has changed. It's gone up and down since prior to the pandemic and into the middle of the pandemic to where current levels are at. We still have Section 179 expensing available to us. It did go up this year to $1,080,000. The total cost of property maximum during the tax year, if that exceeds $2.7 million, you may run into limitations as far as that goes. Bonus depreciation, Dave, is another option if the asset you're purchasing does not qualify for Section 179. We looked at ways to continue to monitor the income or deductibility of those losses that come from natural disasters. So make sure you pay attention to how you're reporting those, where you're at, when they were qualified, and how you monitored that. We do know that here within Iowa, we got a couple of bonus updates. So listeners here in Iowa, we had the automatic coupling last year. We had a couple of state level items change. So we want to make sure that whatever state you're living in right now, you go and check those things out. Kyle's got done talking about some things that are available to retired or disabled individuals, 55 plus or disabled, so we can check in on those. We also know that there are gifting levels available, $16,000 per parent, per beneficiary. That does not count as a deduction for your business, Dave, but it does allow you to transfer wealth to family members. You can pay your children though, which is a deductible. Make sure you monitor the levels again for Fed tax and your state level as well. I know there's more that we covered, but that gets you high level listeners. If you missed it, go back, start over, and listen again. But Kyle, before Dave challenges our listeners to close this out, first, what is some of the best advice you've ever been given?
The first one that jumped to mind, I don't even know if it was someone that told me or I just heard it. Work hard, treat people with respect, and you're going to do fine.
I don't think we've had that one yet, but that is probably one of the most true, Dave.
Mm-hmm.
Yeah. So now for your clients and for our listeners, things that you've seen done well that might benefit our listeners, what are those things?
This may be a little introspective, but I mean, it's knowing yourself. Who are you? What is your tolerance for risk versus not? Know your business, because then that translates into, okay, what type of decisions should I be making? When the CPA says something, is that going to keep me up at night? And I'll be worried about this IRS audit or not, and you're comfortable with that level of risk. And then, based on those answers, that's welcome to tax plan. Mm-hmm. That's what we do. And so the business owners and operators that are thinking about what they're doing as a business and are giving it that level of attention, just as they are about how they get the crops in the ground and how they get them out of the ground. This accounting and tax piece may not be the most fun, and you may not feel like you're good at it or qualified to do it, but it is your business, it is your livelihood, so make sure you treat it as such.
That's good. I like that, Dave. Ready to challenge?
I am.
What do you got?
A little different today, but I'm going to challenge everybody to share their experience. And what I mean by that is we have farmers that have been playing the tax game for 50 years, 60 years. They kind of know the rules, but right now the grandpa, the dad, whoever's in charge does all that. And the young people don't get the knowledge from just watching, learning. I remember watching my dad as a carpenter and learning, why does he hold his hammer that way? Why does he do that? My challenge is take your kids with you to the bloomin' tax appointment. And I want them to learn from experience. Now, preface it when they go, they're going to be the right age, et cetera, et cetera. But we talk about having an advisory board. Hell, your family's your advisory board, Tanner. We haven't talked about your family being the advisory board, but all these young kids I see come out of college, they're like, I got these great ideas. Well, Grandpa and Grandma have some good ideas too. And they have experience of knowing we shouldn't sell this year because I'm telling you, we've already talked with the accountant and it's this or it's that. So I'm going to challenge all the older people to invite the younger people with them.
Or even the younger listeners to
go with.
Request a meeting. Yep.
That's right. To go with. It's like, it's just what Dad does. No, tell you what, I think you should go with Dad.
I applaud that, because honestly, it's nice when you do get the farming operation, the ground, whatever, transfer to that next generation, and they have a working understanding of all the meetings you had prior. I applaud the heck out of that.
It can be totally beneficial. Then they're going to understand the operation just a little bit deeper too.
Okay.
When they do that, no, we can't buy new grain leg. Here's why,
Right.
et cetera, et cetera. We're going to have to pay the government. You have a little more vested interest other than just being the guy that shows up.
I like that. That was a great challenge, Dave. Kyle, we also appreciate you hanging around again, sharing some really fantastic information with our listeners, and we'll put you on the calendar again for next year, right, Dave? It's important enough. We're going to keep doing these at the end of every year and remind those listeners. Listeners, thank you so much for hanging out with us as well, and until next time, have a good one.